Welcome to today's Q Master class on Q Technical Indicators and Chart Templates, Part 2. I am Sagar Nandi. You already have my detail. Disclaimer, I am not an investment advisor. This demonstration is for educational purposes only. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. In Q Master classes, we are going through all the Q systems and the underlying platforms one by one. In the last session, we started with technical indicators and technical charts on Q Elite and Q Global. We are going to continue with that today. In the last session, we covered until watermark. We went through candle, activity bar, trend indicators, and then support resistance in terms of memory and watermark. Today, we'll continue with the rest of the indicators. Many of them. Let's start with the first one, range indicator using channels. Q channel lines are regression lines. They represent a mean price level and then the upper and lower extremes around the mean. Different platforms draw regression channel lines in different way. In Q, it is the mean price level and then the upper and lower extremes. The Q channel lines are available only in Q Global. They are not available on Q Elite. A stock may sometime move between Q channel lines, not always, but sometimes it may move between channel lines, and you may check that before using the channel lines in your trades. For a stock that is moving inside a channel, channeling stock, upper channel is an overbought level and lower channel is oversold level. Mid channel, which is the average value, is the value area. Use these levels to your advantage. Near the lower channel, look for a proper Q buy trade setup. And near the upper channel, look for a proper Q short trade setup. The channels themselves may be uptrending or downtrending. In either case, when it goes to the lower channel, you may look for a buy setup, proper buy setup, not just buy because it is at lower channel, but use proper Q buy trade setup, and the opposite at the upper channel, irrespective of whether the channel itself is uptrending or downtrending. Near the upper channel, look for a proper Q trade setup. Not just using the channel lines, but using Q trade setups, you may look for long or short. If the channel is on a weekly chart, look to enter trade on the daily interval. That way, you will have weekly channel, the longer term interval in favor of your trade. If the channel is on a daily chart, then look to enter the trade on intraday chart using fine-tuned template, for example. Avoid taking trades near the mid-channel line. Instead, use that area to exit trades or to apply trailing stop. Sometimes it may be trending through the mid-channel line and go to the opposite end of the channel. In that case, you may not need to exit the trade, but at least apply trailing stop so that the profit does not erode in case price reverses from the mid-channel line. And if a channeling stock breaks out, eventually the channel will come to an end. Eventually, someday the stock will break out. Then you may look for a proper trade setup, which will be a breakout trade setup either to the upside or downside. Avoid channel breakout trades without pressure, especially if that channel breakout is to the upside. If it is to the downside, then we don't need volume or pressure. these momentum indicators to support the trade to the downside. But if the breakout is to the upside, I'll prefer to have pressure or very high volume. Without pressure, channel breakouts may be false breakout. And one thing that I added a comment that memory breakouts tend to be more significant than channel breakouts. As I explained in the previous session on technical indicators, memory and watermark levels are zero lag levels. They are drawn from the left hand side and they do not change based on the current price move. But other indicators, including channels, are not like that. Channels are redrawn based on the recent price move. That is the average price and the extreme around the average price level. Because of that, my observation is trend line breakouts are more effective than channel breakouts. That's why the Q breakout setup does not rely on channel breakout, but uses memory breakout. Now on Q Global, channel lines are available and there are two channel lines. One is using a longer term period, one is using a shorter term period. So you may see the longer term channel lines moving up like this, and shorter term may also be moving up like this. Let's say like this, two lines I'm drawing for shorter term. Now that is fine. In some cases, however, you will see the longer term, let me draw again, is in an uptrend. Longer term, I'm drawing with 3 lines, and the shorter term starting to turn down. It is still not breaking below this lower channel line, but the shorter one trending downward inside a longer term channel trending upward is an early warning system. And if the price goes below the longer term lower channel, that will be a channel breakout, then you may look for proper Q short setup. And the more you observe these channels, price movement at the channels, the more you will be able to anticipate a trade and probably sometimes take a trade little bit early using fine-tuned charts. Let's look at some examples. This is a stock that was clearly channeling, and that is what I mentioned. We need to look at the stock to see if it is moving inside a channel before deciding to use the channel lines. This stock in this period, this is a daily interval, was moving inside channels. The longer term channel was in an uptrend, upper channel, lower channel, and the midpoint, which is the average line. And you can see the shorter term channels were trending downward, and right at this point, at the right edge, it was breaking below the longer term channel lower line. So you could look for a short setup. Will you look for short setup on this day? Yes, certainly that is a valid day because it is breaking down below the channel line, longer term channel line. We use the longer term channels for trade setups, shorter term channels to anticipate a move. Now you could also start to look for a trade setup right from this day because the shorter term channel was already starting to downtrend, and then we had a bearish shape candle. We could wait for a channel breakdown, or we could take an early entry using this long upper tail, which is a bearish shape candle. We could take an early entry, or we could place a stop short order just below the lower channel line, which would be executed on this day, and then it came down after 2 more days. This is how we use channels. The actual trade setups, we always use the Q trade setups and checklists. We don't want to take a trade just using channel lines. All these indicators in themselves tell something, but together they complete the story. We need the story. We use the story to our advantage to have maximum number of factors in our favor. Let's look at another example. This is a case where again the stock was moving inside a channel, and as I mentioned, when it is inside a channel, the upper edge of the channel is overbought condition. So when we saw that it hit the upper channel, we could get ready to take a short trade and initiate the short trade next day. Was there a Q short setup using daily interval? Probably no. If no, then on this day, how could we short? We could short it using fine-tuned chart. That's what I mentioned, that we may observe how a stock is moving around channel lines, within channel lines in a particular interval, in this case daily interval, and then take the trade in the lower interval. So lower interval would be intraday chart. And it came to the middle channel line. What I also mentioned, that the stock will have a tendency to pierce through the mid channel line, not stop there. So you may not book profit always. You may always book profit if risk distance is covered. That's not a bad practice. Mathematically, that works quite well. But you may continue to hold partial position with trailing stop. I'll discuss trailing stop later. So in this case, you could book partial profit. Risk distance was already covered, and you could hold on to the remaining position at the lower channel line. And then you observe, like I discussed in the previous session, often you will see indecision candles near swing low. So that will be a trigger to book entire position profit, or you could continue to apply the trailing stop, which might have been hit on this day. Now, this stock actually gave a very profitable intraday short opportunity right on this day. So we would be ready looking at the stock at overbought level, and next day using fine-tuned chart, we could short it. I think I have put together the next day's chart also. Next day means this down candles chart using fine-tuned template. This is how it happened. We would be ready at the close of this day. Next day, the early range high and early range low lines form. I'll cover these pivot lines later. The technical setup is early range breakout setup. It went below the early range low. Our stop would be above early range high. In this case, there was another pivot nearby. So we could put stop above the higher pivot line. And when price came to this pause line, already the risk distance was covered. We could book partial profit. And then we could keep an eye on the price inside the channel, and we could continue to hold the remaining position, maybe with a trailing stop. So this was an example where a stock came to the upper channel line, overbought situation, daily interval. Then we switched to intraday interval, looked for a proper trade setup. We wouldn't trade just because it is at upper or lower channel line. We would wait for a proper trade setup, and sometimes it is useful to move to the lower interval to look for a trade setup. Channel lines are one kind of range indicators, and we have another range indicator, that is the boundary line. Channel lines are straight lines, and boundary lines are also range lines, but they are not straight lines. They follow the swings of a stock. We have upper and lower boundary lines. They are drawn based on stock's historical swings. A high liquidity stock tends to remain within boundary lines. Again, using boundary lines, just like in case of channel lines, you may check that out, that it is following the boundary lines before using the lines in your trades. the middle of the upper and lower boundary lines is value area. If a stock is strongly uptrending, then it tends to remain between value area and upper boundary. It does not come to the lower boundary. Strong downtrending stocks remain between value area and lower boundary. They don't go to the upper boundary. Look to enter in those cases where it is strongly uptrending or strongly downtrending. Look to enter a trend following go with flow long trade setup from the value area. And in that case, use the boundary lines as initial profit target. Usually that will give attractive reward risk ratio. If not, we will not take the trade. But visually we'll assess if taking the trade in the value area and taking profit at the upper boundary is giving us attractive reward risk ratio. If so, we'll take the go with flow long trade setup. Why we would like to assess reward risk ratio using the boundary lines? Because our first checking was this: is the stock following the boundary lines? And if it was following, then we will expect it to follow in the near future also. That is why we would like to have boundary lines as profit target in case of go with flow long trade. That means if it is already too close to upper boundary, we may not take go with flow long trade. And there is an exception, that is if the stock is changing direction from uptrend to downtrend or downtrend to uptrend. I'll cover the trade setups in more detail in other sessions. Avoid taking go with flow trades if it is already near boundary lines. Okay, I already mentioned exception is when a stock is changing direction. In that case, it is allowed to take go with flow trade even if price is already above boundary lines. And in that case, we will need something else to decide our initial profit target. One thing to use as initial profit target in such case is to just take the risk distance and book initial profit target at that distance from entry price. Or you could look for the next trend line resistance or watermark resistance. If price is beyond boundary lines, already above upper boundary lines or below lower boundary lines, then look for a reversal trade with a proper setup. What kind of proper setup can be there? Headwind reversal trades. Headwind trades are best taken when price is beyond the boundary lines, because that is overbought condition or oversold condition. And headwind is a unique reversal signal. It tries to anticipate reversal before it happens. So if we are anticipating reversal, it is better to anticipate that when price is extended. And it is extended when it is above upper boundary or below lower boundary. That is why headwinds are best taken when price is beyond the boundary lines, not in between the boundary lines, and certainly not when price is already at the value area. Let's look at some examples. This stock, a daily chart, it was moving inside the boundary lines for the most part. A stock does not always have to move inside boundary lines. Sometimes it may go above it and then come back. Overall, if it is following the boundary lines, we may say that it is behaving properly and we may take go with flow long trade setup. Now in this area, it was in a downtrend, lower high, lower low, then it broke out. We could take a breakout setup if the breakout checklist conditions, meaning high pressure, high volume, was there, and if we could decide a low risk enough stop loss position. Breakouts may or may not give low risk stop loss. Watermark breakouts almost never give low risk stop loss entry points unless they are also associated with gap ups or gap downs. Trend line breakouts, like in this case, may sometimes give low risk breakouts. On the other hand, go with flow long trade setups almost always give low risk entry points when they happen near the value area, which happened right on this candle. It broke out, created a higher low, and then we had a bullish shape candle. And I think this was, for this stock, it was actually go with flow long trade setup. So we would assess risk using protection signal. I'll cover that later. Stop would be somewhere below the recent low, and our initial profit target would be the upper boundary. Entry point is this price. So our risk would be much smaller than the reward. Therefore, you take the long trade and book at least partial profit at the upper boundary. It is always useful to book at least partial profit, not hope looking at this very bullish shape candle that it will keep on skyrocketing. That does not work well over longer term. Because we used boundary lines, we saw the stock is moving inside boundary lines, behaving nicely. We used that to our advantage to take a trade at the value area. Then we should book profit at the upper boundary lines. Not expect that just because we took a long trade, it will suddenly change characteristics. Sometimes it may, that's why we may book at least partial profit and we may hold partial position. If we followed that, we would apply trailing stop on the remaining position, which would probably exit on this day, still with some profit. Partial profit we would have exited at predefined initial profit target. That is very useful. Mathematically, I have observed that instead of holding a stock long term, booking profit and entering again at the subsequent go with flow long trade positions works better. Yes, we have to enter the trade multiple times, meaning we have to track the stocks using QSonar or QFinder and enter it again. But more often than not, at least 70% of the cases, we are able to buy back the stock at a lower price after booking partial position at upper boundary and then applying trailing stop on the remaining position. At least 70% of the cases, that is my experience on well-behaved stocks. But you may observe yourself, that does not mean that we don't hold stocks long term. There are two different investment strategies. If you want to try it out, then you may book at least partial profit always at the upper boundary for go with flow long trades and enter it again once it gives a go with flow long trade setup. In this case, it gave go with flow long trade setups exactly on these 2 days. And I observed, I checked it out, it is not on this chart, that even if you entered the trade on this day, this pullback did not hit the Q protection signal stop loss. That means our stop would not be violated. If we had already entered on this day, probably we're not going to enter again on this day. We would continue to hold it. Our initial profit target would be at the upper boundary again. We would exit partial position. And in the second trade entered either on this day or on this day, partial position would be booked on this day, profit booked, and the remaining you could continue to hold. If I remember, the partial position would continue to be held till the right edge of the stock. Now, how to use protection signal, I'll cover later. It may be useful not to exit the trade using intraday lows. If you have already booked partial profit, you may use closing price to stop out the trade after you have already exited partial profit. And if you did that, I think almost certainly you would continue to have a much bigger run, longer run for the remaining position. In any case, that is how we take the go with flow trade setup and we book profit with discipline. We never not book profit at the upper boundary because that is always our initial profit target when we took the trade. Those are the two range lines, and then we have pivot lines. They are traders pivot lines. Everything is traders indicators. These pivot lines are different from range lines because they are drawn as horizontal price levels. Channel lines are straight lines, but they are not horizontal levels. Boundary lines are neither straight lines nor horizontal price levels. And pivot levels are horizontal price levels. They are drawn on a chart based on historical price moves. Once a level is broken, price may move to at least the next level. That's why they are called, probably that's why they are called traders price level. Some traders may look at these levels and decide entry, exit. I don't do that. I don't use the pivot levels in itself to take a trade, except in intraday time frame, like early range breakout. They rely heavily on the pivot levels. But on daily interval, I don't take a trade just based on the pivot levels. Again, the Q trade setups have unambiguous checklists. We use those checklists, and pivots may provide additional insight and additional confidence. We look at some examples. Pivots may be used to either enter or exit the trade. They may act as either support or resistance. When price comes to a pivot, whether it will be the next support or resistance, we don't know yet. We have to see how price moves at that pivot. If it is acting as support based on the chart looking to the left, then look for trend continuation. So if we have a pivot level and stock is moving like this, then when price comes to the pivot, so far it is acting as a support looking to the left, then look to enter a long trade when we have a bullish bar at the pivot level. And reverse, conversely, if it is acting as resistance, look for either reversal or breakout trades. Resistance may be broken out. So if we have a pivot level and so far price was coming and stopping there, when price comes here, we may look for a reversal trend. Again, remember all the trade setups have candle as a checklist condition. So whether it is a breakout or a reversal, we'll know. There is no ambiguity about that. Reversal will mean it will be a bearish shape candle. Breakout means it will be a bullish shape candle. So there is no overlap between those two kinds of trades. When price comes to pivot resistance, we may take a reversal trade or a breakout trade. This breakout is a basis of early range breakout trade, and sometimes I take intraday reversal trades using the intraday pivots. That is also possible. We have two durations of pivots. Long-term pivots, they are quarterly and yearly pivots drawn on the daily chart on the long-term pivot chart template. This shows the pivots along with three resistance support lines, R1, R2, R3, three resistance lines. So if this is a pivot, it's a yearly pivot, there will be R1, R2, R3, and then there will be S1, S2, okay, let's say S3. The distance between these levels will be decided based on historical price moves. These are traders pivot levels, quarterly, yearly intervals. They are drawn with different colors. And then short-term pivot, they are weekly pivots drawn on intraday chart, usually 5 or 10-minute chart on the short-term pivot template that is used for intraday trading. Shows the pivots along with, again, three resistance lines R1, R2, R3 levels, and 3 support levels, S1, S2, S3. We see how the stock is moving at these support and resistance levels. If it breaks through one resistance, usually we expect that the price will go to the next level. If it reverses, we expect price will come down to the next level. If sometimes you see, especially on the intraday time frame, you may use it on quarterly, yearly pivots also, but especially on the intraday time frame. In either case, by definition, R3 and S3 are the most extended levels. So if you see prices beyond R3, S3, you may be cautious that it is extended, may not look for buy setups, instead may not look for trend continuation setups, may look for reversal setups. Finally, we take the trade by observing how price is moving around pivots. Pivots are not part of checklists, so they are not primary requirements for taking the trades. They provide secondary confirmation, and pivots may also be used as profit booking points. If we already have covered reward distance and see the price is continuing to go up, next pivot is still some distance away, it may be okay to hold on to booking profit and try to book profit at the next pivot level. Let's look at some examples. Again, they are not primary indicators for taking my trades, but they sometimes become useful. Like in this case, this is a daily interval. This level, which was the yellow lines are quarterly pivots, cyan lines are yearly pivots. So we see for a long time, daily interval, this quarterly pivot was acting as support. Price was not going down, and if it was going down, it was quickly recovering. So when price came to these points from above, and then we had a bullish shape candle actually at these 3 points. So we could look for a trend following long setup on this day, and this day. If we took the trade on this day already, we might not have taken the trade on this day. That is how you may use the pivot lines. Does this chart look familiar? This is actually the same chart I used just now with the boundary lines. It broke out of the trend line resistance. I showed that, then it pulled back. This was the value area. From value area, it went up. And I mentioned that we also had two go with flow long setups at these 2 points. And if we care to look at the pivot levels, then we would have additional confidence because we would know that the quarterly pivot was acting as support. And this was the go with flow trade at the same pivot, and 2 more go with flow trades at the same pivot. This is the exact same stock that I discussed just a while ago. And if you observe, after we took this trade from this point, it went to the next pivot level. So when it came here, remember in the boundary chart, it hit the upper boundary also. So we would have another reason to book profit. Anyway, upper boundaries are initial profit targets for go with flow long trade. So you would book profit anyway, but this is just to provide another angle of information that yes, that's a good level to book profit. Then price came back to support, again held support at pivot, and once it started to go up, we would expect to go to the next pivot level. Again, that happened. And from there, see the difference between this point and this point. At this point, we had a bearish shape candle. So we would not expect that price would continue to go up. We might apply trading stop, exit the trade. In this case, second case or third case, second and third, both cases, we would book partial profit either using upper boundary. Upper boundary is actually the proper way to book profit. In this case, the next pivot level also provided the profit target, and then we would not see any bearish shape candle like in this case. So we would continue to hold the remaining position with trailing stop. Trailing stop on a closing basis, because we are not so much in a hurry to exit the trade. We may put trailing stop on a closing basis. Before booking partial profit, it's a decision we have to make. Is it based on closing or based on intraday price hitting the stop level? But after booking initial profit target, it is okay to wait for the price to close below stop before exiting the remaining position. So this is how we use the pivot levels. Let's look at some more examples of intraday pivot. These are available, the intraday pivots are available in the template we call precise entry or intraday entry or fine-tuned pivots. We have different pivot levels. Intraday, we have two charts actually with pivots. One is the traders pivot, R1, R2, R3, S1, S2, S3. Those are traders pivot intraday chart on short-term pivot template. And then we have fine-tune or intraday entry or precise entry template. There we have the daily range, early range pivots. So early range, price range formed during the early morning session. We have three pivots in cyan color: early high, early low, and early mid. They are all in cyan colors. Then we have the daily range lines. Previous day's high, I colored as green, easy to remember. Previous day's low, easy to remember, red. Close, magenta, previous day's close, and today's open is blue. And sometimes price will pause at a level that creates an intraday pivot, a new pivot, that's pause line, white color. They may also be used to exit trades, intraday trades. Use these lines to look for breakout or reversal. Early range breakout entry technique uses the early range pivots. Reversal trades may be taken at any of these major pivots, especially the daily range, early range, these two kinds of pivots. Pause lines are usually used for exiting trades, not for entering trades. All of them are profit booking points for intraday trades, meaning once the risk distance is covered and price comes to any of these pivot levels, we are good to book at least partial profit because risk distance is covered. Mathematically, that works very well. Look at some examples. Magenta line, previous day's close. Price opened very close to previous day's close. Then early range high, early range low lines formed, cyan color dot. Early range mid, also cyan color. And then we have previous day's high. Usually we put stop if we are taking early range breakout. Early range breakout happened at this point. So we would initiate a early range breakout short trade on this bar at the close of this bar. In the morning session, I use 5-minute interval. And then usually we put stop above early range high, except if another major pivot is very close to early range high. Then we put stop above the nearby pivot level. Just a little bit more risk is added. So this should be our risk distance, this much. And then we look for price to hit one of the major pivot levels. It hit some of the pause lines, Not sure if risk distance was covered by that time. If so, we would exit the trade. Pause lines are also exit levels. If not, we would wait for price to come to the next major pivot, that's previous day's low, and we would exit. For sure, we would exit partial profit. We wouldn't wait for the price to go down. In this case, it did, but when we took the trade, our theory was that risk distance has to be covered. So in intraday trades, also for swing trades, key philosophy that works very well again mathematically. Once risk distance is covered, book partial profit and use trailing stop on intraday chart for the remaining position. If you are observing it, you may use trailing stop on a closing basis because profit is already booked on half position or 2/3 position. And at the end of the day, you could exit the remaining position. Will you exit full position at the end of the day or hold it overnight? That is something you would have considered when entering the trade itself. When entering the trade, if you did it in anticipation of a, let's say, a headwind reversal trade, or maybe even a go with flow short trade, anticipation. You took the early range breakout, but you did not know if the go with flow, headwind, bounce, any short setup would be confirmed by the end of the day. And if it was confirmed, then you'd like to continue to hold on to the trade. That is a case where these ranges are used for precise entry of swing trades. That's why they are also called fine tune or precise entry chart for swing trading. And they are, of course, the primary chart for intraday trading. For swing trading, they are secondary because primary decision is made based on weekly, daily at a glance. For intraday, it is primary. Shorter term pivots are also R1, R2, R3, S1, S2, S3 levels. They are not used to enter intraday trades. But once you enter an intraday trade, you may watch the stock on the precise entry or fine-tune template and also the short-term template. Usually, I don't open the short-term pivot template unless I am looking for a level to exit a trade. I don't do day trading so much, so I don't use it all the time. But if you are regular day trader, then your entry will be based on the fine-tune chart. And for exiting, you have these major pivots, and if you need to be more accurate, or maybe the pivot on fine-tune chart is far away, but your risk distance is already covered, then you may use the short-term pivots. In what case that may be true? For example, let's say a stock is at all-time high and it is breaking to the upside from early range. Then we don't expect it to have previous day's high, previous day's low, previous day's close. These levels above our entry price will not have because it is at all-time high. Even if it is not at all-time high, but at a relatively high price level, usually will not have any fine-tuned pivot above our entry price for early range breakout trade. In that case, you may need to have a pivot level to exit the trade, and that is the case. You may open the short-term pivot level. More useful for intraday trading. I don't use the short-term pivot chart for swing trading. I don't use that. But they have certain use, as I mentioned. If we don't have any fine-tuned pivot to take as exit level, and again that happens at all-time high or pendulum high or 52-week high, then we need to have some pivots for exit, and short-term pivots provide those pivots as R1, R2, R3 above entry price. Now, after the pivot indicators, let's look at momentum signals. We have three kinds of momentum signals: traffic light for daily interval, flow, a special case of traffic light, and backdrop for weekly interval. Flow is also for daily interval. These signals show if the stock has bullish, bearish, or neutral momentum using candle coloring. They color the candles. They are not separate indicators, line or pivot. They color the candles. Traffic light and flow, daily entry or intraday precise entry template that also uses traffic light and flow candle coloring, and backdrop is used for weekly candle coloring on backdrop template. We didn't simply change the daily interval to weekly interval to decide weekly momentum. We fine-tuned it a little bit that is appropriate for the weekly, a little bit longer intervals. That's why we don't use traffic light or flow on weekly. We always use backdrop on weekly. You may study traffic flow and backdrop color changes candle by candle for very valuable insight. The more you observe a chart using candle shape and then using the candle colors in backdrop and entry chart templates, you get valuable insight and you are often able to anticipate a trend. The Q trade setups are very robust. You may take them, they are very robust if you are using them, you know. And once you are experienced, you may take a trade little bit early. The more you observe the candle shapes, the pivot levels, the boundary levels, value areas, and these momentum color changes candle by candle, in most cases you're able to anticipate, and in some cases you may actually take an early entry before the checklist conditions are met. But that comes with more experience of using and watching these color changes. Often traffic will change color from green to yellow while price is still going up. Price is still going up, but it will change color from green to yellow. Then it will turn red. Turn red will happen only when price has at least somewhat come down, one candle or multiple candles, but it will change to yellow while price is still going up, many cases. That will show that the momentum is not as high as when it was green. This change from green to yellow, though price is still going up, show visually the change in momentum. Observing such changes helps you to book profit in a timely manner or to apply trailing stop. This concept is very useful. For a stock, let's say go with flow long setup we have taken in a stock, and it went above the upper boundary with a very bullish candle. It was our initial profit target. We could always book profit, but if we see that it very nicely broke above the, closed above the upper boundary, maybe because of earnings or whatever reason, do we book profit? We can always book profit once the risk distance is covered. For go with flow, that's at upper boundary. But the more experienced we are, we may then decide that, okay, it is a very bullish shape candle, bullish color candle, still green, well above upper boundary. I have enough cushion even for my initial profit target level. Then we may watch the color changes. Of course, we could also use the trailing stop, but we could also look at the color changes and continue to hold it with quite high confidence while the color is still green. And when it changes to yellow, then we have to think that should we book profit or should we put trailing stop? And that is the case when we may look at the stock using pivot levels. We may look at its industry. We may see if the stock, if it was undervalued when we entered it, has it become medium valued, which is still okay, but has it become overvalued? So all those things, not only technical analysis using industry, using fundamental valuation score, we may decide to hold on to a stock longer. And the color change in traffic light will also come handy in those cases. We may not need to book profit quickly if the color is remaining green in the traffic light candle color. On the downside, traffic will change from green to yellow and then red, and red to yellow to green. Usually that is the case. From red to green, it will go through yellow. However, sometimes if at swing high, price is extended, traffic switches to red without going through yellow. From green, it becomes red without going through yellow, and at swing high, that shows sudden bearish momentum. If at swing low, it has to be swing low. Sometimes a stock may be moving sideways, very narrow range, and it changes color every bar. That is not significant. But if it is going up at swing high, it was green and then changing to red, then we know momentum has suddenly reversed. And we may use it to look for reversal trades. Again, we'll use proper Q trade setup on the daily interval, or we might move to the lower level, that is the intraday time frame, and look for a reversal trade on that time frame. Traffic light and flow has a difference. Traffic light tells when not to take a swing trade. On a red candle, avoid taking a buy trade. On a green candle, avoid short. Only exception is the extreme reversal bounce setup. Bounce setup is the only one Q trade setup that has a checklist that does not have any requirement on candle color. So it does not need us to check the traffic light color because it is extreme reversal after sharp sudden drop at very robust trend line support. We don't need the color to be even yellow. Even on red candle, we are allowed to take a bounce long trade. Q box headwind setups use traffic light in the checklist. Goithflow uses flow color, which is special case of traffic light. So box, headwind, Goithflow, you may say all of them use traffic light, bounce doesn't. So traffic light tells us when not to take a trade, and flow tells us when to take a trend following swing trade. When flow is cyan, that is an optimal place to buy at swing low, optimal. Before that, it's a bit too early. After that, it is a bit too late. At swing low, that is important. Sometimes we'll have a bullish flow at swing low. That is the maybe the first candle or second candle. That is the optimal entry point. After that, price will go up, and again we may have a bullish flow, but that is not the optimal entry point. That's why at swing low, when we have cyan color, that is the optimal place to buy for trend following long trend. And when flow is magenta, that is optimal place to short at swing high. So we have to have a swing high, then flow turn magenta. That's an optimal short point. And after that, it may have another bearish flow later, but that's not the optimal short point. Optimal short point is when magenta flow is coming at swing high. Q Goithflow trend following setup is based on flow. Flow is the primary indicator for deciding, not the only indicator, but primary indicator in deciding Goithflow setup. Just like for bounce setup, the primary indicator is trend line. For Goithflow, it is the flow color. For headwind, the primary indicator, not the only, but primary indicator is headwind signal. For box setup, the primary indicator is watermark level, double top, double bottom. Weekly backdrop ensures that longer term is aligned with trade direction, not required for bounce trade setup. However, all the other three trade setups that have checklists, Goithflow, box, headwind, all of them have a requirement on backdrop. in the checklists. We'll go through the checklists later when I discuss the trade setups in a separate session. In this session, we are discussing individual indicators. Let's now look at some charts. This is a daily interval chart. These are the points where we had bullish flow after a price pullback. And also in these three cases, price reversed from red to green. Cyan is a special case of green traffic light. So in all these three cases, price went up and traffic light color changed from red to green without going through yellow. So when that happens at a swing low, we are always looking for a buy setup. And when at a swing high, traffic color, in this case, flow also turned magenta, but that's a special case of traffic light being red. So traffic light changed from green to red at a swing high. That's important. So we are going to look for a short setup. Here we already had a lower high. So we had a go with flow short setup that came with sudden reversal from bullish to bearish momentum. So we would have more confidence to take the short trade. In this case, and also in this case, we had, I think we had watermark levels. I'm looking at the long lower tails and I'm thinking there must have been some watermark levels. Price tried to go below that and reversed with bullish momentum, sudden reversal of bullish momentum. So we would have box long trade setup at this point and this point. So observing this sudden change in momentum, it has to be again at swing low or swing high. We could have additional confidence in taking the long or short trades. Now in this case, we also see a reversal candle. So that was a bullish candle from that side also. From candle shape, I think we covered it earlier. It's also a reversal candle. We would have seen that from the band indicator. We would have additional confidence to take a trade at this point. Let's see some more examples of momentum charts. Let's read it using the numbers. This stock was meandering around, not clearly going up, going down. Then it went down. This is weekly interval backdrop chart. Again, the chart templates are designed to be unique. So when we see the candle colors are cyan, magenta, yellow, we know it is backdrop. Cannot be entry chart because entry chart will have 5 color scheme. Green, red, yellow for traffic light, and on top of that cyan, magenta for flow. That is for entry chart. So the moment I see a chart without any label, without any interval scale at the bottom, the moment I see it's magenta, cyan, yellow, it has to be backdrop chart. So in this case, we are looking at the weekly chart, backdrop chart. We don't use traffic light for weekly because backdrop is specially fine-tuned for weekly interval. So suppose we have a well-known stock, let's say Starbucks. Let's say Starbucks sometime in the past. We know it's a well-known stock. We want to buy it. This actually is a Starbucks chart. We want to buy it. So it came down. Then we would observe the backdrop color change from magenta to yellow to cyan. The moment it turns cyan and we are ready to buy a good stock like Starbucks, let's say, then from this point onwards, we look to buy using daily interval, using the Q trade setups. And I'm quite sure you would have some setup along the way, or maybe even at the bottom using a breakout. Certainly there will be a breakout when a stock is changing from sharp downtrend to uptrend. There will be a breakout setup in the daily interval for sure. Now, when we have first cyan candle in backdrop chart after a sharp drop, those are very attractive points to buy a stock that you wanted to buy anyway. Point one is buy the stock using go with flow setup when using not go with flow, using some long trade setup on daily interval when backdrop changes from magenta to yellow to cyan. You may take it using yellow color also, that is based depending on the trade setup we are using. Remember, box setup allows us to take a long trade if weekly is yellow. Headwind also allows us to take a long trade if weekly is yellow. Go with flow does not allow. So for go with flow, you would wait for the cyan color. For box headwind, we could take with the yellow color. Bounce setup doesn't have any checklist condition on breakdown. So initially we would buy somewhere in this ellipse that I drew. Then we could continue to hold on to the stock. And remember, I talked about BOS moving average in the previous session. In this case, you would see those moving averages, or one of them, was providing excellent support. Then it went up. If we wanted to book profit, we could watch that it was getting extended. We would also know that because in this area, it will be well above upper boundary. It will break out of the upper channel line also. There would probably be a channel line. It would break out of the upper channel line. And if we looked at the longer term pivot levels, it would be probably around R2, R3. I didn't check, but it would be above many of the R1, R2, R3 lines. And then we would see indecision candle, then a bearish candle. As I mentioned in the candle discussion, indecision followed by bearish candle is a bearish signal if it comes at swing high. That's how all the different indicators tell something, and when we combine them, we get the complete story. So why I mentioned this? Once long, try to hold the position longer. This is more true for position trading or longer term investing. Swing traders may book profit early, but otherwise not swing position or longer term. Once long, try to hold the position longer using backdrop color until it changes to yellow or magenta. See how price is acting to decide whether to wait for magenta color, which came on this day, or to exit on yellow color. In this case, we would see an indecision candle at the top, then a bearish candle. So if we wanted to exit using weekly candle momentum change and shape change, we could exit at this point. Or we could always apply trailing stop. That is always a safe strategy. Apply trailing stop on the daily. That always a safe strategy. We could do that also. Now, after the pullback, most likely there was a trend line. Price came to the trend line, memory trend line, and stopped there. We would probably wait for the color to change from magenta to cyan. My observation is we don't need to be in a hurry. Now, if there was a bounce, remember bounce allows us to take on weekly backdrop magenta as well. But if we are trying to take headwind, box, or go with flow setup, there was no yellow candle, we would wait for the cyan candle. Maybe somewhere in the middle of the cyan candle during the week it turned yellow. We could take a trade at that time using box, headwind, and then when it turns cyan, also go with flow setup. Again, we will buy it after a pullback in weekly when backdrop changes back to bullish cyan color again. And this case, it did not go through the intermediate yellow. So that was a very bullish reversal in terms of momentum. Look to buy again. Note that in this case, the weekly continued in an uptrend all throughout. That would make the decision to re-enter easier. And looking at it, most likely there would be some channel line or trend line support in weekly and or daily. Now, there is a difference between the first time cyan color after a drop in weekly and the second cyan color after a drop. The second one is in a weekly longer term interval, very confirmed bullish uptrend. The first one is reversal. Now, in this case, you can see the second cyan after pullback, after the second time we had the chance, that was at a much different, much higher price level than the first one. So if you already have a strong stock in mind, like Starbucks, like AMD, like Apple, like Coca-Cola, and you want to buy the stock at an opportune moment, you may always look to buy when in weekly it turns cyan first time after a pullback. And again, there was another pullback here, then a cyan color, so you could look for buying here also. And once again, we see it's a bit cluttered. Let me erase the line. See how different indicators or concepts come together. At the swing low, we had indecision shape candle followed by a bullish at the low. That is always a bullish signal. At the top, when it was overextended, we had indecision followed by bearish. That's a bearish signal. We could book profit. And I mentioned just a while ago, for swing trading, it tends to work very well to book profit at upper boundary and then re-enter at a lower price level. Tends to work very well, 70% or more cases. And that may be true in the weekly interval also for longer term investing. You may book profit once indecision is followed by bearish shape candle. Now, at the bottom, we had a series of indecision candles followed by a bullish candle. So from this point onward, we are anticipating a long trade, and we will be able to take a trade early in the first cyan color candle, because candle shape already told us that it is more likely at a swing low indecision followed by bullish shape that price is going to go up. The same thing happened here. Not only did it pull back, it gave an indecision candle followed by a bullish candle. We would not wait for this long bullish candle to complete. We would be able to take a trade much earlier. Now, once a stock moves with momentum in up direction or down direction, then it becomes extended. And we have multiple indicators to assess the extension. Once momentum moves price to the upside or downside, it becomes extended. It may not reverse, but first it will become extended. Sometimes it may reverse without extension, but extensions are very useful signals for different kinds of trades. Pendulum or price extreme level is one extension signal. They show if price is extended. They compare a stock's recent price with historical moves or ranges to decide extension. They may be thought of as longer term overbought, oversold indicators. Longer term, not shorter term. Unlike stretch, which is a shorter term overbought, oversold indicator specifically meant for swing trading, and the stretch release are very much used for intraday trading as well. The stretch indicator is very fast. We have several zero lag indicators. These are the watermark levels, trend lines, memory trend lines, and also the pivot levels, be it the quarterly, yearly pivots, as well as the intraday R1, R2, R3, S1, S2, S3, daily range, early range, pause level. These are all zero lag indicators. They are used for swing trading and extremely useful for intraday trading. If you think about it, all the intraday trades that we take, they use zero lag or very fast indicators. The zero lags at the pivot levels And the first indicator that I rely on for taking intraday trades is stretch and stretch release. Stretch release is very fast. Stretch release, especially stretch, very fast. So that is very useful to take intraday trades. I don't rely so much on headwind or, for example, boundary levels to take intraday trades because they have lag. They could be used on 30-minute interval, but I prefer to use 5 or 10-minute intervals. So I use zero lag pivots for intraday entry, precise entry of swing trade or day trading. Use pivot levels and stretch. Stretch is very fast. So I came to this point because stretch is very fast, but not pendulum. Pendulum level has a separate purpose. It has much longer duration consideration to decide if it is extended or not. Pendulum or price extreme is used to color candles in price extreme or pendulum template. It is also plotted as a band indicator in daily entry and weekly backdrop templates. So from at a glance, which has daily entry and backdrop templates, we know price is extended or not, and we may see it more clearly visually from the price extreme or pendulum level. Bullish extensions are shown by cyan, green, dark green. Cyan is the uppermost extension. Bearish extension shown by magenta, red, dark red. Magenta is the lowermost extension. Pendulum is used more for longer term investing than for swing trading. Exception is when Q reversal is at pendulum extreme, which is very useful for swing trading entry, usually a reversal entry. Other than that case, with a reversal signal at pendulum extreme, other than that case, pendulum is more often used for longer term investing or position trading, not for swing trading entry. For longer term investing, again, usually we will have a stock in mind. Starbucks, Apple, AMD, maybe gold miners. We want to buy the stock for longer term investing. Look for buy setup at pendulum low and reversing. Q has a ready-made scan for stocks at pendulum low and reversing, both in Q Global, QLN. You may be selective about long-term buying if a stock is already at pendulum high. That is the Q guideline. However, some techniques allow or even encourage buying at pendulum high. IBD, as you know, is one such style. Very, very reputed, of course. I have nothing against IBD. I like IBD's technique also. IBD style trades, which are breaking out of all-time high, are buying techniques at pendulum high. But in Q techniques, I prefer to use it the other way. I have a stock already in mind, wait for it to come to pendulum low, then reverse. Reversal means looking at the color changes from magenta to red, red to dark red, or dark red to yellow, and then look for a Q trade setup. That is buying a stock for longer term investment, a stock that I already wanted to buy at the most appropriate time at the lowest possible price level. Q reversal at pendulum extreme is a powerful signal, and that is used for swing trading very much. That's why Q reversal and pendulum are grouped together in the band indicator, so we can easily see if the reversal is happening at pendulum extreme. Bullish reversal at pendulum low, look to buy, but bullish reversal at pendulum high. It is euphoria, but does not mean an end of the bull run, especially when it is associated with major announcement or event. The trend may continue. And when you see bullish reversal at pendulum high, usually it is associated with some event. Bearish reversal at pendulum high, look to short. Bearish reversal at pendulum low. If that happens, something is not right with the stock. May avoid buying. Let's look at the pendulum chart. not the band indicator, but the chart where pendulum is used to color the candles. Do you think this stock looks familiar? We just discussed Starbucks using the backdrop template. This is also Starbucks sometime in the past. It's a well-known stock. I think all of us will like to buy Starbucks at a lower point when it starts to go up. So here the stock went to pendulum low, red, magenta, dark red. For longer term investment and also for swing trading entry. Every long term investment entry is also a possible swing trade entry point. Especially for long-term investment, look for price extreme or pendulum color to change bullishly, magenta to red, red to dark red to yellow. Look for a Q buy setup. For longer-term investment, of course, we look for fundamentally strong stocks. For short-term trading also, I prefer that. But certainly for longer-term investment, we'll buy fundamentally strong stock. In this case, from pendulum low, it turned to pendulum middle level. So we would have bought somewhere in this ellipse area. Once long, for longer term investing, hold on to the stock while the trend is continuing to go up. And we saw in the backdrop template, it had indecision in the weekly chart, it had a bearish candle. I mentioned we could exit the trade. However, for longer term investment, people may just hold on to the stock, and some more experienced traders, they hold on to the stock, don't exit it even if there are some bearish signals, because they have a large cushion. They may sell call on the existing positions and then exit the call when it starts to go up again. We saw in the backdrop chart also, it had signals at the high level and again at the swing low, and we see it became pendulum high, became pendulum medium, and then again it started to go up. And I think there was some memory trend line at that point. Now, one thing to note that once pendulum color turns green, cyan, dark green, it may remain green for a long time. Therefore, pendulum green is not a signal to exit longer term positions. Changing from red to yellow, or this finer changes, magenta to red, red to dark red, that is the entry point. But turning to green is not the exit point. Because we are here thinking of longer term investing, we'll continue to hold it as long as we can using swing high, swing low, using the weekly boss trend line, looking at industry, looking at fundamental valuation, etc. We'll continue to hold as long as we can. Becoming green in pendulum color is not a signal to exit a long-term investment. For swing trading, anyway, we exit at initial profit target. For longer term investing, we'll hold onto the stock as long as we can. That is how pendulum levels are very useful for entering a stock, buying a stock, long-term investment at a very low price using a Q trade setup. And once price starts to go up, and when you combine with backdrop, pendulum, several other things, they all come together. Most of the time they come together, gives us more confidence. We have another extension indicator, that is jump and thrust. Jump and thrust together, they show if price is extended to the upside or downside. But they are different from pendulum. As I mentioned, Q did not design two indicators that are overlapping. So why did we have jump and thrust? Because it shows extension, but it also imply an element of intensity. Pendulum does not have any element of intensity in it. Not only jump, how far it has gone. Jump shows how far a stock has moved relative to its past price patterns. Thrust shows how fast it went there. Not only thrust, but jump itself also has an element of intensity. And that is why only extreme levels are used in trading decisions. The extreme levels are normalized, so we don't have to look at any threshold. Non-extreme levels are not used in making trading decisions. High jump and high thrust levels show that a pullback is due. Doesn't mean it will happen, but we will be alert. Often it happens though, when jump thrust both become extreme high, many times a pullback happens, but that is not a trade signal. We have trade setups to use, but this helps us anticipate a trade. Look for a swing short setup. Low jump and low thrust level show that a up move may be coming. Look for a swing buy setup. And again, if we are thinking of buying a stock and that gave low jump and thrust, then we are very much ready to buy the stock with a proper Q trade setup. So low jump and thrust may also be used as a stimulus for longer term buying. Because this is extreme low level, if we like the stock for some reason, then that may be a stimulus for longer term buying, just like pendulum is. Pendulum is used mostly for longer term investment. Jump and thrust can be used for longer term as well as swing trading. Both is designed for both. Jump and thrust are plotted as band indicators in alternate entry template, entry 2, and plotted as histogram in the entry and backdrop templates with the jump and thrust variations. We have entry and backdrop templates and another version of entry and backdrop daily and weekly templates with jump and thrust. They help us see the histogram, the jump and thrust as histogram, visually clearer. Most of the time we may rely on the entry 2, which is part of the 3 chart at a glance template. Do we have some chart examples? Let's see. Yes. And here I am using the daily interval jump and thrust, jump and thrust. They show the dots extreme levels. The magenta levels are extreme, red levels mean approaching extreme. If both of them are magenta, it is very likely, if it is a fundamentally strong stock or has something going for it, it's a robust stock, you may say. Not a penny stock. Penny stocks may never recover, some speculative stock, fraudulent stocks. But a robust stock with a good business model, when it hits both jump and thrust extreme at the lower side, many times it goes up. And when it hits, if it hits cyan color at both jump and thrust, then we are too late to buy it. We will not buy it when jump thrust both are at extreme level. It may continue to go up, but we are regular traders. We would have entered the trade somewhere at the low or somewhere along the way. We may be holding partial position. We would not enter a trade even for swing trading if both jump and thrust are in cyan color. Even for swing trading, we will not enter, certainly not for longer term investment. Again, that's how IBD style differs from Q technique. So in this case, the stock dropped heavily. It had extreme low jump and thrust, and then it went up. This would be a beautiful time to start to look for buying. And this stock is not an unfamiliar stock. I discussed this just a while ago. This is also Starbucks. So we can see the more we observe the stocks with different templates, different indicators, we arrive at a conclusion, a trading decision with more and more confidence. So this is also Starbucks. We would look to buy at, in this case, extreme low extension and with element of intensity, not just pendulum low. So we have pendulum for extension, jump and thrust extension with intensity. And then we have some indicators for intensity. Pressure and U-turn show intense move and reversal respectively. Both are drawn as band indicators in entry, both daily entry, intraday entry, and backdrop weekly templates. Pressure is plotted as 1 dot, U-turn is plotted as 2 vertical dots. The more you see the indicators, you see all of them are intentionally designed to be somewhat different. So we know which one is what, even for band indicators. Bullish is cyan or green. Cyan is more extreme than green. Bearish magenta rod or red, magenta more extreme. Pressure is unique indicator because it combines both price move and volume. Traders may consider pressure to be more valuable than heavy activity. In practice, breakout with heavy activity and high pressure are equally effective. So we don't have to only look for pressure. Yes, they are more robust in the sense they have two elements in their composition, but in practice for trading, either heavy activity, that is very or extreme high, not high, heavy means very or extreme high, that is we should have a dot on the activity bar. If we have that with breakout, or we have high pressure with breakout, both are equally effective for breakout trades. You may look for either of them. The same concept is applicable for bounce and box trades. If pressure in one direction is followed by pressure in the opposite direction, that's a U-turn. U-turns are useful to further ascertain a price reversal, that is reversal from memory resistance. If we are having memory resistance reversal with U-turn, then we have even more confidence to take a short trade. Box and bounce setups have pressure or heavy activity, either of them. Pressure is therefore an element of those checklists, box and bounce. Bullish pressure at a lower price level may be a low risk buy point. But if bullish pressure comes after a significant up move, you may look for a bullish exertion. We'll not short it, but we'll look for exertion. We have extension indicators. We look for exertion. We may take an exertion based bounce short trade. Otherwise, we'll wait for headwind trade or maybe a box setup. Bullish pressure coming after a significant up move is a warning. That's too late to take a new long trade. Does not mean stock cannot go up, especially if the bullish pressure at swing high or already after an up move, if that comes with a major event, then the stock may continue to go up, but that still means it is already a bit too late to enter the trade. That will be chasing a stock. We don't like that. Skew traders don't like to chase a stock. We are regular traders, we would have entered the trade long before. Bearish pressure at a high price level may be a low risk short point. If bearish pressure comes after a significant down move, you may look for a bearish exertion. So there may be a bounce long trade setup, or we'll wait for a box long or maybe a headwind long trade setup. With flow setup will not come immediately, but box, bounce or headwind may come after such exertion. Let's look at one chart example. I'll read by the numbers. The pressure and U-turn are shown as band indicators. So red is bearish pressure, green is bullish pressure. Pressure is shown as 1 dot and U-turn is shown as 2 dots. So we had a U-turn here. Bearish pressure came after a down move. So when bearish pressure comes after a down move, we are looking for exhaustion. And in this case, price regained the yellow direction line. In the direction line discussion, I mentioned that yellow lines are significant. Pullback setup is based on that. When price is above the yellow line, going in an uptrend, pulls back to yellow line and goes up again, that is a pullback long setup. And in this case, we had a possible bearish exhaustion. And very next day, not only price regained the yellow direction line, but it had bullish pressure, thereby creating a bullish U-turn that further confirmed the pullback long trade setup. Now the pullback setup was confirmed on this day. We need a bullish candle for a pullback setup, but we could anticipate the bullish setup because the bearish pressure came after a down move near a major support. We would not trigger the trade beforehand, but we could trigger the trade on this day using fine-tuned chart. Also, if you see, this is a bearish shape candle. Next day was not only a bullish shape candle, it was a gap up candle. So there would be many real-time signals in Sonar Finder on that bullish candle day. Firstly, it will show as a gap long trade setup. Secondly, right at the beginning of the day, it will show as a reversal candle. Then it will show a pullback setup. All those will flash in Q Sonar, and if you are using Q Global Q Finder, they will show. So what are the signals it will show? It will show pullback, it will show reversal, as well as a gap long setup. All will be shown right at the open. So we'll be able to take the trade confidently because we also have a U-turn and the bearish exhaustion. I don't know if the U-turn was confirmed right at the open, maybe not, but the bearish exhaustion we had, so we could anticipate the trade, and right at the open, because of so many setups coming together, gap setup, reversal signal, and pullback setup coming together right at the open, we would not wait for the close. That's how studying the pressure and U-turn helps us further confirm the trend. We have another intensity indicator, peak move. This is different from pressure. Pressure tells us today it is intense or not, or today there is a U-turn or not, but big move has a different use. It shows the biggest move, bullish or bearish, over 3 distinct periods: 1 week, 1 month, 3 months. Big move is displayed as band indicator in the entry to alternate entry template. 3 dots, biggest move over 3 months. 2 dots, vertical dots, biggest move over 1 month. 1 dot, biggest move over 1 week. Bullish is green cyan, bearish is magenta red. If 3-month big move up comes at pendulum low, look to buy. Very, very powerful signal. 3-month big move up at pendulum low. And if that comes with reversal, even better. But in terms of intensity, 3-month big move up at pendulum low. Very, very, very useful signal to look to buy. If 3-month big move down comes at pendulum high, look for a short. At the lower end, it is very effective in buying strong stocks. At the higher end, we have to be cautious, and if fundamentals are weak, we are able to take the short with more confidence. Of course, again, we'll use proper Q-trade setup, but this is very, very useful, supportive information at extreme levels. Big move over 1 month periods also provide useful background information. Big move over 1 week may be noted, but not usually used in trading decisions. May be noted, it is there in the indicator, but in trading decisions, we use the big move over 1 month and 3 months more. 3 month big move up after extended rally may signal bullish exhaustion. You may not buy. Certainly, it will be too late to buy. Instead, watch out for a reversal short setup. High growth stocks go up like a rocket, falls like a rock. Eventually, you may see sometimes it will be probably at pendulum high, it will probably at jump and thrust high. And then if we have a 3-month big move up at pendulum high, jump and thrust extreme high, then we know it is sign of exhaustion. We may trade it accordingly if we are holding a long-term position. We will certainly not buy, instead watch out for a reversal short setup and also to protect profit in existing long positions. 3-month big down move after extended decline may signal bearish exhaustion. May not short, instead watch out for a reversal buy setup. Let's look at some chart. This is a daily interval, big move up of 3 months at pendulum low. This 3-month big move up happened to happen at pendulum low that lead to a recovery. And not that it was a very long candle, but this was the first time we would like to start buying with a proper Q-trade setup. 3-month big move up at pendulum low in a well-known stock. This was Tesla. This was Tesla when it was around $40. Very useful signal, 3-month big move up at pendulum low. Stretch is the overbought oversold indicator for swing trading. It evaluates overbought oversold condition for each advanced decline leg. That's why I mentioned pendulum may be thought of as a overbought oversold indicator, but this is across that is across many legs, jump and thrust across many swings, many legs. They are not for swing trading, not designed for that. But overbought oversold stretch indicator, only one. They are designed to see the extended nature for each advanced decline leg. That's why they are useful, very useful for swing trade. They are shown as band indicators in entry, which is daily or intraday chart, and backdrop weekly chart template. Cyan green is overbought, magenta red is oversold. You don't have to look too much whether it is cyan or green, magenta or red. So long as you see it is green cyan color, then you know it is overbought. Similar to activity extreme levels. You don't really need to see whether it is red or magenta. Extreme activity levels are always cyan or green. You don't have to worry whether it is cyan or green. So long as we have the dot, that is enough. Similarly, for stretch, you don't have to really see whether cyan or green is there. Any greenish cyanish color is overbought, then magenta red is oversold. If stretch is overbought, you may avoid taking trend following long. However, breakouts are allowed even if stretch is overbought. Breakout from trendline resistance may come when stretch is showing overbought condition, because earlier it might be moving in a squeeze even. So when it is moving in a narrow range, a little bit move up, breaking above trend line resistance will make it overbought. So breakout trades with stretch overbought is allowed, but not allowed for trend following with flow long. It's not part of go with flow checklist because when stretch is overbought, usually will not have a bullish flow at swing low. Usually will not have that. So we don't need a separate checklist on stretch for go with flow. But this is the concept. If stretch is overbought, you may avoid taking trend following long. Sometimes you may find a go with flow setup where stretch is overbought. Then you may be cautious. If stretch is overbought, don't take a go with flow long unless it was moving inside a very narrow range or relatively narrow range, so that little bit move up made it overbought. It has still some way to go before the upper boundary is hit. You may take that in that case, but in general, if stretch is overbought, avoid taking trend following long. Breakouts are fine. If stretch is oversold, you may avoid taking trend following short. Usually they may not come if you apply the checklist, but sometimes they will come. Breakdown trades are fine if stretch is oversold. Stretch helps anticipate a reversal at watermark, memory, or the pivot levels, quarterly, yearly pivot, and certainly for the intraday pivot levels. I use it all the time for intraday trading decisions, anticipating a trade and taking the trade early, but not too early. Early relative to many other traders, but not too early, meaning if I'm watching stretch on intraday, let's say morning session, fine-tune chart, 5-minute interval, I am seeing it is overbought on the stretch band indicator. I'm anticipating a short trade and then I see it stopped at a pivot level, starting to reverse. But if the candle color is still green, remember on green candle, we don't short. So I wait for it to at least turn yellow and cross below the pivot. That's a reversal. The actual reversal trade may be taken based on stretch release. I'll not discuss stretch release today, but just looking at stretch being overbought helps us anticipate a reversal. Very useful. Very, very useful, especially for precise intraday reversal trade at pivot resistance. Actual trade is triggered using stretch release, but we can anticipate and get ready. Maybe we can, if we are trading options, we can decide which expiry, which strike, get the symbol, put it on the trade bar. Everything is ready, and once the release comes, we trigger the trade. But we have to get ready with the symbol, everything. We may do that once we see it is becoming overbought. And you may also use it to get ready for box reversal setup. Same concept, but on daily interval. Box setup has two indicators, key indicators. One is watermark level and also the stretch release. Stretch release is the eventual change from stretch. Okay, I will cover stretch release also. Give me some more time. They come together. It is a reversal signal after the overbought condition, stretch release. No advance or decline lasts forever. We have several reversal signals, but stretch release is the first one I'm discussing so that we can continue with stretch. No advance decline lasts forever. Overbought and oversold conditions eventually come to an end. That is plotted as a stretch release. And as I mentioned, this is a very fast signal. So we are able to take reversal at watermark, for example, very quickly. Watermarks again are zero lag indicators and stretch release is very fast. So that gives us the optimal shorting and longing points. Stretch release is shown as band indicator in entry, daily and intraday charts, and also backdrop weekly. They are also plotted on the candle chart when the release is tradable. It's important. Release has to be tradable. So what does it mean? Tradable. I mentioned that, let's say price is going up, then we see stretch is overbought. we can see that from the band indicator, stretch is over. We are getting ready. Then we see a stretch release. We may see a stretch release in the band, but we may not see a stretch release on the candle. Why? Because the candle color may be green. Green candle color doesn't allow us to short with stretch release or box setup or intraday reversal at pivot. So if the candle color is green, we may still find the stretch release in the band, but it will not come on the candle color. So that's very useful for traders. It's plotted on the candle chart only when the release is tradable. So the release on the candle chart takes into account the traffic light color as well. Makes our life as easy as possible. Green is bullish release, oversold no more. Red bearish release, overbought no more. So release always comes after stretch. Stretch release is a reversal signal that is a key component of the box trade setup. That's a reversal at watermark level. And very useful for intraday reversal trade at pivot level using the release. Align that with traffic flow momentum. Avoid shorting a green cyan candle. Avoid buying a red magenta candle. And as I mentioned, the plotting on the candle will not happen if the flow traffic light are not aligned. Also look for heavy activity or high pressure at or just before the release. In effect, that is like a box setup. So box setup has certain checklist requirements. Activity or pressure are also part of that checklist. In the intraday time frame also look for the same high pressure activity at or just before the release. And here I want to explain something. We are thinking about a reversal at a pivot resistance that may in a daily interval that may be a box at watermark level. So this is a, let's say this is a watermark level or intraday pivot, doesn't matter. Then price came here, fell down, came here again. That is the only time a double top, triple top, or a intraday pivot that we will be able to use stretch release, not the first point, because we need the pivot level to exist, be it watermark or intraday pivot. So pivot level is there. When it is reversing, what we are thinking that earlier sellers pushed price down. So some selling may be left. Retail traders may be selling all the way to lower and lower and lower prices. The experienced traders will like to sell only at high prices. If they have more inventory to sell, they will like to sell at that price again. The opposite is true at watermark support. Now we need high activity to show that the reversal is happening. That is the checklist. But one thing to note that high activity present at the previous stop allows us to take a shot at the stretch release point, even if at this point activity may not be very high. If activity is very high or there is a pressure, either of those conditions, heavy activity or pressure at the previous touching point for the pivot, be it for watermark or intraday, that also allows us to take a short trade at this point. So that means sometimes if we look for stretch release with activity, we may miss some of the shorting opportunities because the activity high heavy or pressure may not be at the current reversal point. It might have shown at the previous point. At this point, it may not be visible. So it's fine. We can combine both also. Still, we'll have plenty of trading opportunities. But I wanted to mention that we don't need heavy activity or pressure at the current reversal stretch release point if we had heavy activity or pressure at the previous touch point. In checklist, probably it was difficult to articulate like that, but I explained it. We have other reversal points. I will not cover them, but let's look at one chart for stretch and or stretch release. This is a daily chart using watermark level. Watermark levels are white levels. And we see the stretch release here. Green stretch release on the candle that is tradable. Red stretch release on the candle, it is tradable, meaning it was also considering the traffic light color. At all the 3 points marked 1, 2, 3, 1, 2, and 3, the stock created false breakout with stretch release. False downside breakout, false downside breakout, false upside breakout. What is false breakout? It went above the pivot level, luring breakout traders in only to reverse immediately. That's a false breakout. And we have false breakout. Box setups are even more powerful with false breakouts. Why? Because the breakout traders have to exit, and they are exiting. In this case, short breakout traders have to exit. They have to cover. That will add to the rally. And in the upside breakout traders bought at high price level. They thought price is going to go up. Sometimes it may, but many times it doesn't. And we had a reversal with stretch release at watermark resistance here. Reversal with stretch release at watermark support at these points. So those confirmed box long at these 2 points and box short at this point. The same concept could be applied to the intraday time frame. Activity also we would check. Activity is part of the checklist of pressure. I am not showing the activity yet. Now I want to point out one thing on this chart. We had a bull release at this point also. We had a bull release at this point. But we have the checklists and we discuss the candle shapes. Candle shape is a component of all Q trade setups. So on this day, we will not be able to confirm the box long setup because it had an upper tail. Upper tail candles are not bullish. We are not allowed to take box setup if the candle shape is not bullish. So this day we would not take the long trade, but this day confirmed a box setup. If we look at this bear release, this candle shape was bearish. So we would be able to take the short trade at this point. And in this case, the bull release came with a bullish shape candle that met the checklist conditions. We would be able to take long trade here. Stop would be above the recent high or below the recent low. We could use the protection signal. And in case of box setup using stretch release or intraday setup using reversal setup using stretch release and pivots, we would like to book profit once the risk distance was covered. We would not wait because these are reversal setups. That's the difference between reversal setups like headwind, bounce, box, and trend following like go with flow and pullback. Pullback is also reversal in a way, but mostly trend following longer term. For trend following trade, we may sometime decide to hold on booking profit, but for reversal trades, we always like to book profit once risk distance is covered because trend is a friend, and in reversal trades, trend is not with us. We are at 2 hour point. I am on slide 30, but I have more than 50 slides. So let's end today's session here. We are at 2 hour point, past 2 hour point. We'll continue with the technical signals and technical charts in next session. That will be the third session on the topic. I think we'll be able to complete it in the third session, and then we'll have sessions on many things to cover on technical analysis. First technical scans, then finder, then sonar, maybe finder sonar combined together, then Q trade setups. that will end the technical analysis. So thanks for joining. I look forward to seeing you in our next session. Yes, it's a weekend. Have a great weekend. And as always, no reason not to do that. Trade profitably. Thank you.